You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning there, Jim. We're looking at a dull day in Vancouver and sunshine shining on the New York stock markets.
What's happening in Toronto?
Oh, it's set back a bit. You know, the gold story isn't so good, and the crude oil story isn't so good. And here we got, crude oil is now down trading at 65.75, and in June or thereabouts, it was trading at 107. And then going back to 2008. It soared up to $147 a barrel, and that was on a speculative rush in a number of commodities, but the main one was crude oil. And the story was peak oil. The world was about to run out of oil. Well, technically that thing was dynamic. I mean, our upside exhaustion things worked very well on that one, and we advised that when the weekly upside exhaustion came in, we advised that it would likely be a cyclical bear market, and then by the end of that June, as it was closing, the monthly upside exhaustion kicked in which case we concluded that it would likely be a secular bear market. So, and then for going back to this time last year, a number of important commodities were really quite beat up, base metals, copper, energies, oil and whatnot. So gold and silver were also beat up. So we thought that there'd be, and we called it a rotation for, lack of another term, where you'd get a rally on these things out to the spring somewhere, and we did. So that was the one that moved crude oil up to 107, at which point it was overbought enough to say, exit the trade. But also at that time, I started to write about and using natural gas as the example where, mind you, natural gas was a continental price here in North America. But it had been on its highs sort of up at $12 and $13, and then came fracking of natural gas fields, and, the price crashed with the other crashes and all the way down to $2, and now it's back to a $4 level. So that was the writing on the wall for crude oil, that it would take an adjustment. Now, it wouldn't sort of like fall from 12, the equivalent of 12 to 2, but down to a new low price trading range. And this is what's happening here. You sort of think about it when you write it last May or June, that, that adjustment is going to come way out there sometime, who knows what year. And then you just say, well, you got to write it anyway. So then, in September, the idea of adding to that was that the problems with Putin in Ukraine and all of the crazies in the Middle East, their revenues depend on a high price of crude oil. So back in the early 80s with President Reagan, he'd worked out a side deal with the Saudis that on a decline in crude prices, that Saudi would not trim their production and not try and defend the price. And it crashed. It went something like 34 down to 10. I remember the 10 quite vividly in early 86. Well, then that sucked all the money, or stopped the money going into Russian pockets. And that was assisted the end of the evil empire. So here you now have Putin coming back as a neo-Soviet with ambitions that are absolutely absurd, and he's dependent on dollars flowing in and on petroleum flowing out. Well, the price has come down to this now 65 level. So then there's one other thing going on in crude oil, and that often you can have a seasonal low in December or maybe early January. So then, in yesterday's piece, looked at it all and looked at previous, let's call it a crash in crude oil prices. And they have a tendency to crash for 6 or 7 months. So the high was back in June. So, hey, we're at 6 months, 7 months. So, perhaps a low sometime in the next 6 to 8 weeks. But it's not going to be one of these V-type bottoms. Each of these previous crashes we looked at, it took a couple of months to stabilize and get it going again. So we wouldn't rush into the stocks. Oh yeah, the stocks on the oil patch, the XLE ETF in the States, got super excited in June, and we noted the technicals and advised people to stand aside. So these oil patch stocks would also take a month or so to stabilize once the decline ends. So there's some very exciting times in energy price markets. And at this point, you can't put a target on how low it's going to go. We're not getting any technicals on it, no sequential buys or anything. So I guess it's going to go lower.
What about people who say if we have lower gasoline prices, that puts a lot more money in the pockets of consumers, and that's going to help drive the economy?
Oh, yeah, there's always that story, because this has been on since the 70s when OPEC suddenly realized that they could jam the prices up, and then you had the first energy crisis, and then it's sort of become a legend that as energy prices go up, it's sort of a taxation. This is not to mean the tax on each gallon of gas at the pump. The whole thing, the price structure moving up, is some sort of a taxation, and they would worry about crude oil going up and affecting the stock market and everything else. But the truth of the matter is that crude oil is another commodity, an important one, but so is copper, so is coal. So at any rate, our view, and then they also updated it last month with some charts showing the price of crude oil and the vertical bars for recession. And a falling crude oil price is, or let's back it up one notch here, a rising crude oil price is part of a boom. And that's prosperity. And then a falling crude oil price typically happens within or at or somewhat before and after a recession starts. So this crash is adjusting for a huge supply increase in petroleum products, but it's also adjusting probably for a cyclical contraction. I mean, things are not going so well in China, and things are not going so well economically in Europe. Recent, like the last few months in the United States, are showing some pretty good numbers on employment and things like that. So, car sales, that is now more robust than it's been for some time. But it could be ending action as far as the economic expansion goes. So we'll just see if this weak crude oil price is telling us about a pending recession.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye, Chief Investment Strategist for Institutional Advisors. Bob, with the lower crude prices, where should people be putting their money if they're interested in energy?
In their pockets.
That sounds like a great solution.
No, we're out of the play since June, July, and you stay out until the markets tell you when it's time to go back in. And that's also we were looking at the general stock market. You had the correction into October, and at that point on the S&P, it kicked in on our what we call the springboard buy pattern, and things have lifted off. We also had the springboard buy pattern in the junk bonds as well, and they lifted off. But on the stock market here, we're getting enthusiasm, great enthusiasms again. Like bang, it shook the market. 10% correction on senior indexes, 18% on Russells, and a bigger percent drop in European stock market. So we're back to exuberance again, measurable exuberance. And now the market this week has registered one of these Hindenburg omens, which is a form of volatility in the stock market that you get before an important top. It's a bit elusive as to the time from when you get the signal as to when it rolls over. The other one that we got, which I thought fascinating, was on the world's biggest stock, Apple. That action has been outstanding, and our model on outstanding moves is called upside exhaustion, and you run it daily, weekly, and with monthly numbers. And oftentimes on some stocks, just a weekly is sufficient to say, hey, the game has reached its best. But this one is registered on the daily, weekly, and monthly. So it's three things. We call it the trifecta. So all of the good is likely in the big move in Apple. It's a major stock leader, and it should roll over here in the next few weeks. But other than that, yes. General stock market is again become very exuberant and impulsive. And you get seasonals coming in here from the middle of December through to the first week in January. Typically small caps like the Russell 2000 outperform the big caps. That doesn't say whether both are going to be going up or both will be going down or one relative to the other, but it is a relative performance thing. So then, looking at some commodities again, the grains continue to act well. That's that GYX. And a week ago, we were thinking, oh gosh, if it doesn't make it beyond 327, it might take a rest for a while. So it got up to 329, and so it acts well. Base metals, we've been looking for a low in copper, say around November, December. It's not there yet. And we've already wrapped up on the energy side, so we'll look at the precious metals sector. And our guidance on that one was that the speculative rush into May, June, triggered off our danger signals, and the advice was to take money off the table. And we're not yet in any particular buy pattern, although the sector is becoming very attractive. So in order to be cautious on this one, we look at the gold divided by, gold shares divided by gold. And all through the last few years, you had the gold shares underperforming gold while both were acting poorly. This is stabilizing now for the last 3 weeks. You had a really good oversold low in that ratio between gold shares and the gold itself. You also had, it was down to the extreme low, I think, last seen in 2001 or something like that. And, so you got downside momentum, and you also have at a support level. And it moved up, bounced up, and corrected, and back down, and then had another rally to a little higher, and now it's correcting. So we would like to have that stabilize for maybe 4 or 5 weeks. It's very difficult to get the low trade, but it's best to have this particular aspect of the precious metal market stabilized before one makes a serious commitment to it. But for nimble traders, we would begin to acquire some gold stocks now. The other part is if we get a rally for gold and silver, of course, on this kind of one, silver would outperform gold. So we're also looking for the gold-silver ratio to turn down, or silver-gold ratio to turn up as well. So the platform is being built for the next rally in the precious metal sector, and one should, I think, you can just be patient and cautious to get some stocks in there. So that's the brighter side is perhaps in the new year for the precious metal sector.
Bob, thanks a lot for chatting with us.
Good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.